Now, many people have asked me, the S&P 500, the Nasdaq, some other indexes have consistently performed well over any kind of 30 or 40 year period. In fact, they've consistently beaten, for example, bonds or some other indexes over the long term. So some people ask me, why not just put 100% in the Nasdaq or 100% in the S&P 500 if your time period or time horizon is long enough? Now, the main reasons you shouldn't do that is this. Number one, obviously, you don't want to put all your eggs in one basket. Now, I agree that over diversification can be a problem, but you don't want to put 100% of your eggs in one basket. Number two, the past isn't always an indication of the future. The US market is true, has outperformed other major stock markets now for pretty much over 100, 200 years. That doesn't mean it's going to happen the next 100 years. Number three, every dog has his day, as the saying goes. So for example, now the Chinese stock market is coming up, but it's had an awful 15 years really, but it's done very well this year. But it's still not back to where it was a few years ago. Likewise, the UK market or the German market, whatever, there's always periods where the international markets beat the US market. So for example, from 2000 until 2008, the US stock market was doing very badly after the Nasdaq and all that kind of thing, the dot-com burst. And international markets, especially emerging markets, performed well in that period, and government bonds performed much better than US stock markets in that period. Likewise, this year, especially in March when the markets were crashing, government bonds did very well compared to stock markets. That means, therefore, that if you have 3 or 4 different investments in the same portfolio at least, when one is doing badly, you can always rebalance. So let's say, for example, you've got, 70% in the S&P 500, 20% in government bonds, 10% in international, and March came along. Well, what can you do? You can sell some of the bonds and buy some of the cheaper stock prices. So by having different eggs in your basket, it's not just reducing risk. You can actually diversify yourself. And every time that a crash happens, you can actually sell from one to the other. So many researchers have actually shown that in the last 20 or 30 years, somebody who's had, say, for example, 30% in bonds, 70% in stocks, hasn't done that much worse than somebody who's been 100% in stock indexes, for a simple reason that if somebody rebalances when the market crashes, that can actually increase returns. Because you take it this year, when markets crash so heavily, so quickly, what a great opportunity it would have been to actually sell some of those bonds and buy cheaper stock prices. And also having bonds means you don't have to keep a lot of money in cash.